welcome to our weekly look ahead at the markets. And we've got some questions coming up in the coming few days. First up, how does the big tech earnings hold up? We had Snap reporting earnings last week. Revenues were a miss on expectations, slowest growth since it IPO'd, and that had a big effect on the stock. The Snap shares were down 25% in the after hours trade ahead of the open on the Friday. So that had read across for the likes of Pinterest, Facebook and Alphabet. Now, Facebook and Alphabet are among the companies reporting this week, so we wait to see what kind of impact they're seeing from the slowdown in the weakening digital advertising space. We did see Snap average revenues per user down 11%, so we think there's clearly a problem in the space. Alphabet, now it reports this week. It was its last quarterly earnings were down, were weak, and we saw revenue growth down to just 13% from 62% the prior year, and the expectation is for revenue growth of just 9.6%. So keep an eye on that one. Microsoft, less involved in the digital ad space, but certainly a big tech name, and it's just announced significant layoffs, and the 10% revenue growth that is expected would be the weakest for 5 years. Meta are expecting revenues to decline by somewhere between 2 and 11% on its Q2 earnings call. It had guided for a continuation of the weak advertising demand to continue. Apple reports of iPhone 14 sales being weak and slowing production of that. Bernstein saying it's vulnerable to a slowdown. Its recurring revenues represent just 10% of its overall income, and therefore is vulnerable to a macro slowdown. And Morgan Stanley, more upbeat, saying that their quarter-end checks suggest that demand for the iPhone 14 is actually not too bad. Those are the earnings coming up. We've also got the ECB now. I'll be live here covering that one. European Central Bank expected to hike interest rates by 75 basis points. It could go a bit more, but I think 75 looks pretty solid. That's going to get it close to that sort of neutral rate that it thinks it needs to get to. And we have been hearing officials sounding pretty content to push the button on an aggressive rate hike, with Eurozone inflation around that 10% marker. And then on inflation on Friday, we get the US PCE index. That's the Fed's preferred gauge of inflation. Now, we have seen that getting pretty hot. It was up at 4.9% in August, so we saw acceleration. We also saw the core CPI number. That's the key one, that core CPI, a different release that came out a couple of weeks ago. It was up 6.6% in the prior month, and we did see 0.8% in services month on month, and that services number is important because that's stickier than the goods number. So services inflation is broadening, and that gives the Fed more impetus to raise interest rates, particularly as the employment market, judging by last week's unemployment claims number, looks pretty solid, and we think the Fed's going to keep on with these rate hikes. And that's going to be a problem for the market. We are suggestive of the earnings season at the moment, suggestive of a peak earnings cycle. And then finally, got the UK political shenanigans to keep an eye on here in London, expecting the Tory party to have a new leader by the end of the week. And what that might mean for sterling and for gilts and for UK equities, we're not quite sure, but we'll try and keep you posted here. Thanks for watching.